pertain to our own market. We're joined by Ryan Felsman from Colonial First State Global Asset Management. Of course, my guest host today, John Noonan from Thomson Reuters. Look, thanks very much for your time today, Ryan. Talk us through your feelings around the US.
Well, I think the most important thing for investors is around the debt ceiling as far as the timing and deadline of the resolution. So the key thing for investors obviously is the focus on whether a default will occur immediately or not. Now in terms of that, we've got a 2-week window. On the 31st of October, we've got the first interest payment on debt due, around $6 billion worth. And obviously if the US Treasury has insufficient cash to pay out the interest, then therefore that would see credit rating agencies likely downgrade the US sovereign credit rating. You've heard Fitch today talk about obviously a possible downgrade themselves on their AAA rating. So if that was to occur, then that would lead to a technical default.
What does another downgrade, so let's say Fitch and Moody's joins the party and downgrades US AAA credit rating, what does that mean? What are the broader ramifications?
Well, in terms of markets, I think the first issue would be around whether bondholders would be compensated in terms of the coupon payments. So you'd possibly see a rally in US Treasuries, but then that may instigate a sell-off further down the track, and possibly see 10-year yields rise to around 3% perhaps. Equity markets would obviously sell off as a result of a potential technical default. The gold price would likely increase. And the other thing we need to take note of is the fact the US dollar and Australian dollar movements would occur around that as well. So there's been concerns around the US dollar as far as it being a reserve currency, particularly from a Chinese perspective. And then that has a knock-on effect to the Australian dollar perhaps. We could potentially see the Australian dollar continue to increase despite an initial decline. Basically, we've seen domestic data improve along the lines of an improvement in business confidence to a 3.5-year high. Consumer confidence is improving. We've seen an increase in the momentum in the housing data in particular around house prices, home sales, an emergence of construction activity. Take that into account as well as far as the increase in Chinese data momentum, where that's surprised on the upside. We might have GDP growth for the September quarter released on Friday be above 7.5%, so that could provide some sort of support for the Australian dollar as well.
Ryan, John Noonan from Thomson Reuters, on that very subject, the Australian dollar and the Reserve Bank and his feeling towards it. There was quite a few reports I read this morning from investment banks overseas feeling that the RBA minutes that were released yesterday were actually a hawkish, there was a hawkish tone in those minutes.
That's right, John.
Yeah, I mean, they didn't really change too much of the statement, but they seemed to, when I drilled down deeper, those analysts felt that it was the RBA seemed a lot more relaxed about the recent rise in the Australian dollar. And for that reason, they believe that it was a more hawkish tone. Do you think the RBA is more relaxed with the Aussie dollar now that we're back around 95 cents again? Well,
I think the RBA's preference would be for the Australian dollar to fall. That would obviously act as a shock absorber for the transition between the mining and non-mining sectors of the economy. That would facilitate that and also boost net exports as a contribution to real GDP. But at the same time, reading the minutes yesterday, there was a slight easing bias retained, but certainly the RBA's position currently is still in a neutral wait-and-see mode. It's kind of data dependent. And obviously we've got the CPI, the inflation read for the September quarter released on the 23rd next week. That's expected to be well contained and benign. So therefore I think the hurdle, particularly with house prices rising, I don't suggest that there's a housing bubble evolving as yet, but certainly the hurdle for a rate cut has increased. Markets are certainly pricing in a low probability of a rate cut in November, and in fact markets are pricing in a likely rate increase over the next 12 months, if anything.
Ryan, you're right, the market's actually starting to price in an increase. I think 15 basis points worth of hikes for the over the next year, which is a turnaround from just a couple months ago. But if the Australian dollar now, if it does form a base around this 95 cents level, of course the market's going to be looking at parity. This transition from the mining sector-led economy to a non-mining sector-led economy, surely that's not finished yet. I mean, and so wouldn't a strong Australian dollar make that job much more difficult for the RBA as they try and support that transition?
Absolutely, John. I think certainly, as I mentioned, the transition from the mining sector to the non-mining sector will be made more difficult by an elevated Australian dollar. But at the same time, if the RBA cuts by a further 25 basis points, I don't see that resulting in a substantial decline in the Australian dollar immediately. I think, obviously, the improvement in Chinese data, the fact that the Fed has postponed its tapering, has put a support behind the Australian dollar presently. And if anything, as I said previously, Australia may be considered to be a bit of a safe haven if the US credit rating is actually downgraded. So if anything, I think the Australian dollar will trade in the near term around its current levels. But obviously, there are forecasts out there suggesting the Australian dollar will fall back to up to, say, 85 cents, thereabouts, over the near term to medium term.
Ryan, what's your view on the outlook for the cash rate? As both you and John mentioned, the market now starting to price in the potential chance of a rate increase. I mean, where do you stand?
Well, our view previously was there was a potential for a rate cut in November. Obviously, the RBA were in wait-and-see mode, as I said, data dependent. Australian dollar dependent, but at the same time we've got the CPI inflation print for the September quarter to be released next week, and if benign, we thought at the time that perhaps, with taking into account the Fed potentially tapering back in September, which it clearly didn't, that we may see a rate cut as well. At the same time, we're also seeing employment conditions weaken in Australia. The unemployment rate fell to 5.6% last week, but that was predicated on the back of a falling participation rate. So certainly hiring intentions are weaker, but what we're seeing perhaps post the federal election, more certainty around the political situation in Australia. We're seeing that obviously business confidence has now risen to a 3.5-year high, but that's kind of counterbalanced at the same time by current conditions. So current conditions are suggesting that hiring intentions for Australian businesses still remain weak. So we need to see an upturn in the business cycle, particularly around business investment and consumer spending, to also pick up some of the slack, apart from obviously the housing market as well.
Ryan Felsman, great to have you join us today. Thanks very much.